and welcome back to Nolan Financial Radio. My name is Tara Nolan from Nolan Financial. If you're new to the show, welcome. Today, we are going to be talking about taxes, everyone's favorite discussion. But before we jump into that, I just want to say, if you are new, please go visit my website at www.nolanfinancialpartners.com. While you're there, you can actually click on the radio page. We record all these shows, and there's lots of educational topics. We do everything from Social Security, Medicare, IRAs, 401ks. Pretty much if it's a financial topic, we talk about it. So you can go back there and you can subscribe to listen to it on Apple Podcasts or Spotify. And it's a great thing. And you can also feel free, if there's a question you have, especially about the topic for today, you can give Chris and I a call at 719-210-4242, and we can answer that question for you, because there's no lack of information out there. It's just like, okay, all this information is coming at it. How do I know what matters for me? And
Sure.
So that's why having that conversation is great. But before we jump into the show, let me say, Tony, how are you doing today?
Well, I am great, Tara. Thanks for having me on the show. This is a lot of fun. Even if we're going to talk about taxes today, I think we can still manage to have a great show and have some fun, because taxes, people might groan and go, I don't want to talk about taxes. No one wants to hear about taxes, but I think minimizing your tax burden is a good thing, and understanding changes that are happening so you don't overpay in taxes. That is a critical thing. So I'm glad you're talking to us about that today. But I've had a great week. It's been kind of crazy. I've been really busy, and the list of things I have to do for my wife has just grown. And I get one thing done, and I checked 2 things off today, and then I look at the list and I go, it's longer than it was when I started. How does this happen? So I've been good, though. How about you? You guys, you just got back from a trip to Germany. That's huge. I've always wanted to go there. How was it?
Yeah, it was amazing. So I got to bring Chris. I was actually there on an Air Force program. So while I was in class during the week, Chris got to spend time with the spouses. So it was Chris and all the ladies. And
That's awesome.
They had a fabulous time going out, and they toured a different castle or monastery every day, and then had coffee. And, Germany, we went to Oberammergau, it's like the fairy tale part of Germany. Like if you were all the little houses and it was the winter. So it looks like you had just shaken up a snow globe.
Oh,
and that was the town. So it was a very, very cool trip. We were able to take a lift up to the top of the Zugspitze, which is the highest point in Bavaria. And
wow.
So just amazing, an amazing trip. And
That's awesome.
I'm so grateful that with my life, that I get to do these kinds of things, that I get to help people with their finances, and I still get to be involved in some of the service to the country. And then when you get to combine all the things together, isn't that like the best?
Well, it is. And all these experiences you've had with your life as a pilot, flying the big planes, and in the military, and travel and finances, you have a lot of experiences to share, which is why I'm excited for your book that's coming out. You're an author now, and you've been working hard for a long time on this book. And so we're getting closer and closer down to the wire where the release date, it's next month, right?
It's in March, and it's with the proofreader right now. And so
excellent.
Proofreader, typesetter. And so the only thing, keep your fingers crossed, is I'm being told the last hurdle might be with the interruptions we've had with the supply chain because of the pandemic. There might be one more delay in getting books printed.
The printing, yeah.
We'll see. It's that I've been finding my Zen place writing this book of okay, what are the things I can control and what are the things I cannot?
Yeah. Well, and you're good at looking at that and planning for that and setting expectations, and because that's what you help people do. You and Chris, your husband, and your business partner, Chris, do with Nolan Financial, and you help people with their finances. And today we're talking about taxes, right? I mean, this is an important topic.
So we're going to talk about taxes and retirement. And here's my lead-in question for those folks listening today is, I would say, if you think rate of return is the most important thing in retirement, you are missing the boat. And let me just say that again. If you think your rate of return that you're earning on your 401k or IRA is the single most important thing to your success in retirement, you do not understand how to retire in this country. And
Wow.
so
That's a bold statement because I think that's what the majority of people assume is the most important aspect of their retirement planning is what type of return am I getting on my investments, my 401k, my IRA, my 403b, what have you.
and let me just ask this question, Tony. Do you know any legal way that you can earn a guaranteed 20% every year?
No.
If you do, sign me up.
Yeah, exactly. Wouldn't that be something?
And Tony, this is the conversation we're having today is if you understand tax strategy and maximizing getting your money from taxable and tax deferred places into tax-free places, that's going to save you more money than any return on the market. And I talk to people, Tony, if I could just show you a way that you could change your money from a tax deferred status where you're paying your ordinary income rates that are around 20-24% and show you how to get that money tax free, that's like I've shown you how to earn 20% in the market because
Wow.
I've shown you how to save taxes.
Yeah. So, and what you're saying is a lot of people don't realize is that 401k, my wife and I have 401ks. The majority of Americans today have 401ks with their jobs. Some people might still have a pension, but are a 403b, or they have a traditional IRA. So that traditional IRA and traditional 401k, they think, okay, I've got in my 401ks and IRAs, my traditional, I've got $100,000. I'm just using that as a figure because it's easy.
Math,
yeah, but so what I think you're saying here, Terry, is if you got $100,000 in your 401k or traditional IRA, you think I've got $100,000 to use in retirement, and that's what I'm planning on. But really, you have 20 to 30% less. 20 to 30% of that is the government's, it's Uncle Sam's. So it's more like a joint account. And that's the frustrating part and the part people aren't thinking about is what you're saying.
Exactly. And you've nailed it, Tony, is you look at the account and you think you have $100,000 and then all of a sudden you realize like, that's not all mine. It's really frustrating. And here's the next thing I always ask is I want people to really, Tony, today is all about concepts, right? It's if you can get the concepts, I can show you the details and the tools to make it work. But here's my next question is, Tony, do you think taxes are going to go up or down in the future?
I don't think that's a trick question. I think most people would say, taxes are going up, right? Well, I think they will be.
We were just talking about that, right? The tax reform that the last administration did in 2017, if nothing changes, is going to sunset in 2025. And taxes are going to go back up to where they were, right?
Right.
So if nothing happens, and do you think there's a chance that Congress might not get something done?
Yeah, I think Congress is pretty deadlocked right now, the way things are set up. I mean, things can change politically. They could do something to raise taxes at some point between now and 2025. But if they do anything to taxes, if they manage to get anything done, Tara, which I agree with what you're saying, they probably won't get anything done. But it's not going to be lowering taxes. I'll tell you that. It's going to be raising taxes because of all the money, the trillions of dollars in government spending that's happened over the last, number of years, 5 years.
And so that's right. So the best case scenario is we know taxes are going to go back up a little bit in 2025. And the odds are maybe that'll happen sooner, but I don't see taxes going down.
No, no one does. I mean, nobody has a crystal ball, but right now, I mean, that the current tax bill is set to sunset and then the taxes reset in 2025 under the current plan or under the current laws. So taxes are basically on sale right now, right?
Yeah. Now, I don't want people to get me wrong. Just, so listening is I do active money management with money that's in the market to make sure that we have downside protection and we're mitigating risk.
Sure.
And that has to happen. So I'm not saying that doesn't have to happen, but it's not the biggest factor. And when we're talking about a holistic plan, when you look at your whole financial picture in a big bubble, everything together, the most important thing you have to do first is manage your tax strategy. And you have to be tax efficient because otherwise you're going to be paying money that you could be avoiding.
Sure.
And
Because the money in the money in your traditional IRA and 401k and a lot of traditional retirement accounts, whatever type of account it is, typically that money is taxable when you pull it out. That's all you have to pay tax on that. It's tax deferred, so you're not paying taxes today, but you're paying taxes when you really need that money the most in retirement, when you need that money to live on or to pass it along. That money, Uncle Sam is going to want the full tax amount on whatever you take out of there, and you eventually have to take it out. They make you. So that's interesting. So that's a problem in retirement. A lot of people think, oh, my taxes are going to go down in retirement. The taxes are the least of my worries in retirement. But what you're saying, you're turning it on its head and saying, no, actually, taxes are probably the number one way that could cost you money in retirement.
It absolutely is. And I just, it's really interesting to sit down with people and they're like, well, what's the rate of return you're going to promise me in the market? And I'm like, well, first of all, no one should be promising you rate of return because no one knows. The best case you can do is do predictions and show. But sure. I have so many people that they're worried about their rate of return. And then I look at their account, Tony, and they're retiring from a company and they'll have, $700,000 or $800,000 sitting in their 401k from work in a traditional 401k. And I say, well, what is your tax strategy? And I get a puzzled look.
Yeah.
What do you mean my tax strategy? Like, well, you've got a really big tax bill sitting there. You've done a great job building your 401k nest egg. What is your plan to get that money tax free?
Yeah. Imagine the $800,000 you've got in those retirement accounts and over 20% of it, poof, not yours.
Right.
That's ouch. That's what I like to call ouchie. Right.
And so, with the book, the title, Tony, is Money Moves. Changing where your money lives changes how your financial world grows. And so this is like one of the very basic tenets is, when you have money that's in taxable or tax deferred accounts, like a traditional 401k or IRA, there's got to be a plan for how you're going to get that money to move over and become tax free so that it can grow tax free, because we're all living longer. So we've got to have that money available. And so the tax efficiencies is what we've got to look at. And Tony, you just hit on it, like the example that everyone knows about is RMDs.
Required minimum distributions, or really massive donuts, as I like to say on the show.
And then the age right now, what's the age for when you have to take them? Didn't it just change?
72.
72.
Right? Yeah.
Tony, 72 is like the new 40.
That's true. People are living longer and longer. And
they're still working. And do you want at 72 to be forced to start taking money out of your account if you don't need it?
Yeah. And paying taxes on it. Right.
Which is why that rule exists, right? The government forces you to take the money out so that you pay the taxes.
Sure.
And so it's all about being in control of your money. And so when you have your money in these taxable accounts, you lose a little bit of control because there's rules that are around everything. And so it's just, I just want to foot stomp this so much that you've got to have a tax strategy as part of your overall retirement plan, because you got to know how you're going to spend that money and how you're going to be taxed to make sure that you are reaching your maximum financial potential.
Yeah. And that's huge. And so I think I see where you're going with this. Obviously, there's a solution though, right? And so what would you tell our listeners to do, and how do you direct your clients? I know everybody's situation is different, but how can we avoid that big ticking tax time bomb that is a traditional IRA or 401k? What do we do?
Well, and that's a great time, Tony, just to take a little break and just say, for the folks that are listening that have this situation, especially where they have a large 401k that they don't know how to tax plan for it, please give Chris and I a call at 719-210-4242 and set up that complimentary appointment, because like Tony's saying, there is a way to deal with it, but it gets very specific for each individual at the individual level. So give us a call, 719-210-4242, to set up that appointment so that we can show you how to take the strategies that we're talking about today and apply it to you for success in your life. And Tony, people can also visit the website, www.Nolan Financial Partners. You can book a discovery call right online there as well.
Yep.
And
NolanFinancialPartners.com. And Nolan is Nolan, of course. And that's awesome. And they can also go there and go on your radio show page, and they can listen to past shows, look for topics that interest them or that they need information on, and watch those shows. And they can subscribe to the show as a podcast. We're available on Spotify and Apple Podcasts. And that way they can listen to it on any device, a tablet, their mobile phone, computer. Every time there's a new show, it'll be available in that app. And it's really easy to use. And so I think that's great. I would encourage our listeners to, though, also give you a call. What's that number again?
Sure, Tony. The number is 719-210-4242.
All right. Well, we talked about required minimum distributions, and we're talking about traditional IRAs and 401ks, but there are options. So you mentioned there are strategies and options. Are there tax-free retirement vehicles out there that we can start putting money into, or that people should be moving money into?
There are tax-free vehicles. So the Roth is one that everyone's heard of. And so here becomes the trick of it, right, Tony? Is say you have this large 401k and you want to get it into a Roth a Roth account. The question becomes, well, if I move all that money and convert it, I'm going to have a huge tax bill. Like say you have an $800,000 account, and if you try to convert that all in one day, you're going to have a big tax bill.
Yeah. Yeah.
And you have to pay those taxes. So this is where that team effect that I'm always talking about, Tony, is that you work together as a team. This is where you bring in your CPA, your tax planning, and say, I want to get this 800K as one step. There's a lot of moves, but one move is to get this 800K from a traditional account into a Roth account. How do I do it? Do I do all of it? Do I do part of it? How much do I do every year? With what I'm making in my job, how do I figure out the right amount so that I don't pay more in taxes than I have to? And there's a process. Like, you don't have to guess, but it's kind of a challenge to figure it out by yourself, to go, okay, what's the right way to do that?
Well, yeah, you should not do it on your own. You really need to be working with a financial services professional. You and Chris can help people with that. But regardless if it's you and Chris or someone else, we need to urge our listeners, do not do this planning on your own. You need to work with a financial planner, hopefully a fiduciary that is going to look out for your best interests. So find a trusted financial services professional like you and Chris, Tara. But now let's talk about, I wanted to ask you about, you say, we're talking about moving from a traditional 401k or IRA into a Roth. Explain a Roth. What is a Roth 401k? There's Roth 401ks and Roth IRAs. And what are the benefits of those versus the traditional?
Well, my favorite analogy for this, Tony, is it's the farmer analogy. So if you had an option as a farmer, would you want to pay tax on your seed, or would you want to pay tax on the crop?
Oh, the seed for sure, because it's smaller.
It's smaller and it's not proven yet. So
yeah,
that's the way a Roth works, is you're going to pay tax on the seed.
Right.
But the way it works with your 401ks and your traditional IRAs is you're paying tax on the crop, and you're paying it at your ordinary income tax rates. So by moving money from a traditional account to a Roth, you're going to pay the tax up front for the money to go into that Roth. But then, Tony, once it's inside that Roth, and I like to think about the Roth, it's just like a bucket. So you put your money into it, but once it's in that bucket, it's a tax-free bucket. And so after the money's in there, then you can spend it like you like after you're 59 and a half, and you don't pay any taxes. So it just doesn't matter.
You don't even have to pay taxes on the interest earned. You don't pay taxes. You won't pay any more taxes on the principal or on the interest earned, and you're still getting that compounding interest. It's still attached to the same growth vehicles and stocks, but you're getting that interest and being able to pull it out when you need it. It's all tax-free at that point.
And I love you said that. Here's a thought to chew on, Tony, right? Because the money, like you said, once it's in the Roth bucket, it grows tax-free. So think about that. So your money that's sitting in your traditional account, your interest is growing, But guess what's also growing? Your tax bill, right?
Yep.
Because it's in a taxable bucket. So you
The
have,
longer it stays in there, the bigger your tax bill is going to be,
and
probably.
people don't forget about that. It's like your size of your account is growing, but also the size of your tax bill.
Yeah.
And so that's where you want to figure out what is the right timing and the right way. And it takes roughly, a good rule of thumb is about 7 years. Once you move money from a traditional account to a Roth, after about 7 years, the money starts to break even, and then it starts to shoot through, and then everything you make is ahead, and it's tax
Yep.
free.
Yeah. So the sooner the better on getting these tax-free options going, then, is what you're saying. Yeah.
Right. Time is our best friend.
Yeah.
So people always think rate of return is the biggest thing. It's not rate of return. Time is the biggest thing.
Yep. It's time in the market, and you don't want to try to. Yeah.
Yeah.
Yep. Exactly. So your time horizon is important, and this is where, from what I hear you saying here, Tara, correct me if I'm wrong, this is where we get into why everybody's situation is different, because you have a different time horizon, and that really plays a part. Then you talked about that 7 years is kind of the window after you do a conversion into a Roth IRA or 401k versus the traditional. So you have to look at your time horizon, and that's what you help that's what you help your clients figure out, right?
Exactly.
That's awesome.
It's just a lot of details. And I think, to me, it's the frustrating part for my clients is that there's decisions and concepts that you get, but you have to understand the second and third order effects of your decisions. And that's where, Tony, I find a lot of the do-it-yourselfers get in trouble, is because their intention is correct, but they have to understand, if they make the decision, how they do it. Like, just for example, if you decided, oh, I need a Roth, and you move all your money in one day, then you may have created a tax bill for yourself that was big, and you didn't have to create that tax bill to be able to get to that account.
Wow. See, that's important. That's great. And I have another question for you, though, Tara. You were talking about required minimum distributions earlier with your traditional 401k and Roth IRA, your traditional tax deferred accounts. The government eventually makes you start taking withdrawals, whether you need them or not. With a Roth IRA, are there still required minimum distributions?
There are not.
Ah, that's
the
another
money,
benefit.
and I like to talk about your money having more than one job. The money inside of a Roth, it's growing tax-free.
Yep.
It puts you in the driver's seat, because once the money's in there, then you're not going to be directed by the government when you have to take that money out. So you actually get to be back in control of your money.
Sure.
And it's a protected place to grow. So a lot of good things happening when you get your money from a taxable environment into a tax-free environment.
Wow. Yeah, that's another perk right there then. And then there are other rules, though. I think you have to have, if I'm reading the information that you sent me on today's show, you have to leave the money has to be in a Roth IRA for 5 years, a minimum of 5 years. So before you can take it out tax free. Is that right?
That's how but the thing is you only ever pay taxes on the gains. So you do have access to the money, but yes, to get it fully open and have it 5 years.
Fully tax-free is 5 years, which,
and that goes back to, Tony, like I was saying, that there's always little caveats and provisos, right?
Sure. Yeah, there is, like my favorite rule that is on pretty much any retirement account that's designated as a retirement status is the 59.5 rule that the government has, that the IRS has, that you have to be at least 59.5 to take that money out of a 401k or IRA or Roth IRA, Roth 401k. And it bothers me that they went with 59.5. That's just classic U.S. government nonsense. Like, I just imagine that meeting, like they couldn't agree on 59 or 60, so they went with 59.5 to complicate the math for people like me. It's
Right.
like, come on, what are you doing? Yeah, that's crazy. But yeah, so there are rules, and you can get deep in the weeds on the ins and outs, and that's why you need professionals who keep up with the changes to there's every year it seems like they're changing the rules on us with retirement accounts and taxes, the IRS, and other retirement aspects like Social Security. And you and Chris are staying up on that and working every day on these things with your clients. So for our listeners out there, if they need advice on this and need to know what's going on right now, you have to work with a financial services professional.
It sure makes it a lot easier, Tony, because it's a lot to keep up with. And because I'm a big believer for myself in second opinions. And so even if I think I know exactly what I want to do, I always like to talk to somebody that knows a little bit more, because either one, it confirms, hey, I was on the right path.
Yeah.
Or two, it's like, I hadn't considered that. I'm glad I know that now.
Yeah. Yeah, that's great.
You never lose anything by checking.
That's right. So another thing, before we have to go here, we have a few minutes yet. We just have a couple minutes left. What about Social Security? I always hear, and I always thought, I never thought about Social Security being taxed, because most of us are going to get Social Security checks in retirement. Can Social Security be taxed?
Tony, it absolutely can. And I'm so glad you brought this up, because I just went through this with a client last week where she was pretty sure. She's like, well, I know if I take it a little early, I'm going to have to pay the taxes on it. And I'll just, I'll just pay, how much can it be? And she didn't understand it. It's more like a penalty for taking it early, because she was still going to be working. And so she wanted to take her Social Security and continue working. And she didn't understand. I'm like, it's not really a tax. Like, you're not going to get all the money because you're still working. And so it's not a smart idea to take it early unless you have like some kind of overriding situation going on in your personal life, where you've got a health condition or something like that. If there's any way possible for you to wait and to take it on time, or actually usually even delay it, that generally works out to be better, because it's designed, like, all the rules are in place, right? The government, they don't do it for their goodness of their heart. The government says, here's the rules, and they want to set them up so that you leave the money as long as possible with the government so that it earns as much. So when it comes time for taxes, you pay the most.
Right, exactly. And I think the rules are good, like 59.5, because that's supposed to be for retirement. So you don't want to take the money before you retire. Same with Social Security. And the way they penalize you is if you make over a certain amount. And I'm not sure what it is for this year, because it always changes, but it's somewhere between 17 and 20,000 or somewhere in there. So if you it's low, it's a low number. I mean, how many people work and make less than, hopefully, if it's a full-time job, you're not making $20,000 or less. Then they're going to, for every $1 or $3 you earn, they take $1 back of Social Security. So it's like it really lowers that amount. So if you're planning on working and earning very much money, I mean, if you're just working part-time and making less than 20,000 a year, then they're not going to penalize you like that. But if you're making more, they're going to withhold your Social Security or a portion of it. So it's crazy to take it at 62 if you plan on working until you're 70, right? Plus federal, you can pay federal income tax in certain circumstances on your Social Security, up to 85%, I've heard.
It is, but it's one of those things, like a logical person would go, hey, I'm working, but I'm eligible for Social Security, so I'm going to get extra money. I mean, that was the way a logical person would think.
Sure.
But this is what makes money hard, is that the rules are not all based in logic. And so you have to understand, it's not to my advantage to take it early, because that thinking of, well, I'll just take it early and have more money and I can invest it and do whatever. But it's not always as simple as you think it should be.
Sure. Well, hey, we're out of time for today's show. It was a great one, Tara. Why don't you give your information and let our listeners know how they can get a hold of you one more time?
Sure, Tony. The bottom line from today's lesson is rate of return is irrelevant if you don't have a good tax strategy in place. So give Chris and I a call, 719-210-4242, if you're ready to look at your overall financial plan and make sure you have a tax strategy for retirement. That number, 719-210-4242, if you want to make sure you have a tax plan to set you up for success in retirement.
All right. Thanks, Tara. And listeners, that does it for today's episode of Nolan Financial Radio.
Join us again for another episode of Nolan Financial Radio. Take care, and we'll talk with you next time.